So it's my great pleasure now to introduce our next speaker, who truly is a remarkable businessman. It would appear that Michael has been extremely busy recently as he's preparing to re-enter the mutual fund industry in a new way. Michael E. Chin was born in Jamaica and immigrated to Canada as a student. Michael's financial career started when he became a financial advisor and progressed to the position of branch manager. Michael's first acquisition was a small Ontario-based investment firm called AIC Limited. Within 20 years, AIC grew to surpass $9 billion in assets. Under Michael's stewardship, Portland Holdings stands today as the parent to more than 30 diversified companies operating in sectors that include financial services, insurance, telecommunications, hospitality, tourism, media, and healthcare. Today, Michael will speak on the new direction he is taking, specifically the need to have a mix of both public and private securities in your portfolio, and the benefits that can be derived through accessing investment opportunities that have generally been beyond the reach of the average Canadian investor. And following Michael's presentation, we will have a few minutes for some questions. So, ladies and gentlemen, it's my pleasure to introduce Michael E. Chin. Michael.
Thank you very much. Good morning, ladies and gentlemen. Oh my gosh, you guys are dead. Wake up. Anyway, this morning's eminent audience reminds me of an event that occurred in Toronto this past summer. So this wealthy businessman had a party. And as the Rolls Royces and the Mercedes drove up to his home, the valet services ushered the cars to the parking lot. When the party got to its highest crescendo, the mischievous host said to his lieutenant, "Turn the music down, because tonight we're going to have a contest. And the contest will be between all the eligible bachelors. And we're going to see who can swim across my indoor swimming pool, and the first man to alight from the pool can either choose my beautiful daughter's hand in marriage or $1 million. So gentlemen, line up, on your marks, set." Before saying go, he said to his lieutenant, "Open the gate." And in swam the killer sharks. Then he said, "Go." Nobody moved. "Go." No one moved. All of a sudden, this one fellow was in the pool, flailing away, sharks chomping at his heels. Miraculously, he alighted from the pool unscathed. Panting now, he went over to the host, and the host said, "My gallant victor, congratulations. Now, which of the two prizes would you prefer? My beautiful daughter's hand in marriage or $1 million? He said, "Neither. I just want to get my hands on the SOB who shoved me into the pool." So, ladies and gentlemen, today, this morning, I'm not here to shove anybody into doing anything. But I'm here to suggest that already we are all in the pool. And the sharks that are chomping at our heels are the fact that we have had a lost decade. The markets have gone nowhere in the last 10 years. The fact that we have our business being quickly commoditized. Our business is one of margins racing to zero. Am I right? The fact that we are not differentiated in the marketplace. The fact that our reputation as advisors is not at an all-time high. So those are some of the sharks that are chomping at our heels. So, when I first came into the business in 1977, I recognized that there are three things that we as advisors have to do very well in order to build a most successful practice. And these three things are not unique to advisors. In fact, every business has to do these three things in order to build a successful business. The first is we have to make sure that whatever we do, everything we do, lead to augmenting our reputation. Because it's our reputation that will determine access, that will determine acceptability, and better margins, reputation. Secondly, I recognized from the get-go that whatever we do, everything we do, we have to make sure that we differentiate ourselves in the marketplace. Because at the end of the day, we aren't measured by our samenesses. We're measured by our differences at the end of the day. And thirdly, I recognize that whatever we do, everything we do, all roads have to lead to one place. Do what is best for the client. So those were my three motivating forces from the get-go in the business in May of 1977. So I thought to myself, okay, when I sit in front of a client, what is the highest value added I can give to this client, this prospect? What's the highest value added? Well, you know what? The client is saying, how can my lot in life be enhanced, my financial lot in life be enhanced, so that when it's time for me to hang my gloves up, whenever that is, I have enough capital to continue my lifestyle in the manner that I've become accustomed. That's what the client is asking for. So therefore, basically what the client is saying, Mike, please, I'm trusting you with my future. I'm trusting that you're going to do the right things with my future. And what I don't have is time. Because if you waste time, and as we all know, the wealth can be distilled down to a mathematical formula, the future value formula. FV equals PV times 1 plus R to the nth power. The only variable in that equation, the most important variable in that equation is time, N. Because it's the only variable that's exponential. All the other variables are linear. So make sure however you arrange my affairs, Mike, you don't waste time, because it's the most important variable in the wealth creation formula. So therefore, I thought, okay, is there a formula? If clients are saying, please enhance my wealth, make sure you arrange my affairs in such a way that I become as wealthy as I possibly can, give my cash flow today. So wealth creation is my first and primary responsibility to clients. Now ask yourself this question today, ladies and gentlemen, advisors. How many of us see ourselves as being wealth creators versus wealth managers, which is shuffling the paper around, basically? How many of us see ourselves and are acting as true wealth creators? How many of us? Versus being wealth managers, which is a cop-out as far as the client is concerned. So I thought, if that is the case, if that is what is required of me, is there a formula that connects every single wealthy person in the world? Is there a formula? Are there some common behaviors, some common practices that connect every single wealthy person in the world? Because if there is, I want to know what that formula is. I want to know what that behavior is, and that's the behavior I'm going to educate my clients on. Does that make sense? So the question is there such a formula that we can say every successful person is linked by? Is there? And if there's such a formula, does anyone in this room want to know? So is there such a formula? Yes, there is. It came to me in 1979. And it came to me in 1979. I read this book, The Money Masters, written by a New York investment counselor, John Train. And as I was going through the different chapters which chronicled the various American investors of the day, I was getting frustrated because I could not see. I'm an engineer by training and practice. I could not see myself extrapolating from the squigglies, whether the squigglies came from interest rates, the economy, the stock market, stocks. I couldn't see myself making decisions based on historical squigglies. So I was getting frustrated until I came across a chapter in 1979 on Warren Buffett. And that was my eureka moment. So what did I learn from Mr. Buffett then? And ask yourself the question, whether or not the lessons from then are relevant and appropriate today. And ask yourself further the question, what should therefore my clients be doing? And what should I be promoting to my clients? So what did I learn from Mr. Buffett in 1979? Firstly, wealth is created by owning, and there are 5 points basically. Wealth is created by owning a few, not too many, high-quality businesses. Few high-quality businesses. Secondly, every single wealthy person, in fact, let me make it more interesting. What's your name, sir? Brian. Brian, think about any wealthy person anywhere in the world. And by the way, Brian, have we met before? We have never met before. So this is not a setup, right? Okay, so Brian, think about any wealthy person anywhere in the world, any gender. You could be thinking of anybody, right? I'm going to define to you the 5 things that that person did. Now, what's the likelihood of me getting it right? 5 out of 5. High or low? I don't know what you're thinking of. What's the likelihood of me getting it right? 5 out of 5, 100%. What's the likelihood? Low, right? You could be thinking about anybody, anywhere in the world, any gender, etc. Any sector, any industry. But here are the 5 things. Number 1, I'm sure, Brian, that that person you are thinking of created his or her wealth by owning a few high-quality businesses. Am I right? He said yes. 1 out of 5. Brian, I'm sure the person you're thinking of created his or her wealth by really making sure that he or she understands those few businesses. Am I right, sir? Understand is a hallmark of investing. Thirdly, I'm sure that 2 out of 5, that person you're thinking of, Brian, created his or her wealth by making sure that those few businesses that he or she owns are and understands are domiciled in strong long-term growth industries. Am I right, sir? 3 out of 5. Fourthly, I'm sure that that person you're thinking of, Mr. Brian, created his or her wealth by simply using other people's money. Am I right, sir? 4 out of 5. Last one. I said it has to be 5 out of 5, right? Because I'm not taking chances with my client's future. So I have to be absolutely right. And lastly, Brian, I'm sure that that person you're thinking of, sir, created his or her wealth by simply holding those few businesses for the long run. Am I right, sir? How would I, Brian, we have never met, how would I guess your mind so crystal clear? How? How is it possible for me to have nailed it 5 out of 5? How? You could have been thinking about anybody anywhere in the world, right? How is it possible? Because Brian said consistency, and that's how wealth is created anywhere in the world, right? Were you all thinking about someone? Did I nail it 100%? So if that is the case, and a client's, so can we therefore conclude that there are some principles associated with how wealth is created? Can we conclude that? Those are 5 points I learned from Mr. Buffett back in 1979. And I committed myself that until someone can give me a better way of creating wealth, those are the 5 principles I'm going to be promoting to my clients. And that's the first conversation I have with any prospect and every client. First conversation. Can you think of a more relevant conversation, Brian? Can you think of a more relevant conversation? Over and above defining how wealth is created anywhere and everywhere in the world. So the next question is, how do we make sure that a client accepts and behaves in that way? Because there's a simple formula to be successful in any endeavor. Number 1, identify a role model. Number 2, ask the role model for the formula. Role model, how did you do it? Give me the recipe. And number 3, don't change the recipe. Don't put your thumbprint on it. Execute the recipe faithfully until the only time you have the opportunity to change it, the license to change it, is when you're more successful than your role model. Right? So I thought, Mr. Buffett, who is more successful than him as an investor? Nobody. So I'm just going to follow slavishly those 5 points. Simple. And by the way, what he said, what I do, he also said, what I do is simple, not easy. What I do is simple, not easy. Understanding the 5 points, simple. But practice them over the long run, not easy to be consistent in that behavior. But it's easier to be consistent in any behavior if you know what your principles are. Am I right? Most advisors don't have any principles when it comes to creating wealth or having a way of organizing portfolios. So that was my eureka moment in 1979. And that was my commitment. And still today, if you can tell me of a better way to create wealth, I'm all ears. I'm a student of wealth creation. That's what my clients are asking of me. That's what your clients are asking of you, not wealth management. Firstly, wealth creation, then wealth management after. You can't manage if you don't create. Okay. So now, what I did as a curious student of the industry, having defined principles of how wealth is created, I said, let me now superimpose the behavior of the industry that I'm now in, the behavior of your typical mutual fund manager, against those 5 points to see whether there's consistency of behavior between how mutual funds are managed versus how wealth is created in the real world. Let me see. First point is wealth is created, Brian, by owning a few high-quality businesses, right? Few. Less than you have fingers on one hand. Your typical mutual fund, would you say your typical mutual fund has only a few high-quality businesses? Would you say so? Your typical mutual fund would have 100, 200 different businesses. Am I right? So does it pass or fail? On the first count, let's be honest now. Pass or fail? If wealth is created in this way everywhere in the world, how come in the mutual fund industry, the money managers are trying to create wealth by violating the first principle? How come? So does it pass or fail? It fails. Secondly, Brian, wealth is created by? What's the second point? Understanding what you own. If you own 100, let's now superimpose the behavior of managers versus that second principle. If you own 100 different businesses, ladies and gentlemen, is it possible to really and truly understand them all? Pardon me? So does a mutual fund product pass or fail on the second count? Let's be honest. Fail on the second count. Thirdly, wealth is created by, Brian, what's the third point? Well, making sure that those few businesses are domiciled in strong long-term growth industries, right? So if you own 100 different businesses, some will be in good industries, some will be in average industries, some will be in bad industries. Why would a rational person consciously go out and invest in a mediocre or bad industry? Why? But if you own 100, you own a collection of all of them, right? So does it pass or fail on the third count? Pardon me? Fail. On the fourth count, what's the fourth? Brian? Fourth principle is wealth is created by using other people's money. Okay, if you own 100 different businesses, are you absolutely sure that you have 100 qualified, 100 CFOs that are qualified and have good judgment? Are you absolutely sure? You can't be sure. So if you're not sure about the acumen of the CFOs of the businesses you own, does that make you feel confident or no confidence? No confidence. Right? If you can't be sure of your CFO and how his or her behavior is, that's not investing. So does the mutual fund product fail on the fourth count? Yes. And lastly, what's the turnover rate of your typical mutual fund? What is it? Turnover rate. Typical mutual fund. How much? What percentage per year? The last time I looked, it was 80. 80% a year. So what does that mean? Flip it around. It means the average hold period is 14 months. Ladies and gentlemen, name one business person in the world. Just one, please. And there are hundreds of millions of them. Just one. Who buys and sells his businesses every 14 months. Just one, please. Eh? Name one. I don't know of any. So when our money managers turn over the portfolio every 14 months, does it violate the fifth principle? So I thought, this is crazy. We are, as an industry, are producing products that are dysfunctional. And please, I'm very transparent, very open, and I tell it as it is, as I see it. And I thought to myself, this is nuts. I am not going to be a part of promoting something that is not based in principles to my clients. And hence the reason why we started AIC. And hence the reason we started AIC. And hence the reason why I continue to, in my role outside of AIC, I look for great businesses, not too many of them, to invest in, that I want to hold for the long run, and are in strong long-term growth industry. And I use other people's money prudently, hopefully. So far, so good. Okay, so the point I'm making, ladies and gentlemen, is please, we should, I go back to Warren Buffett, because a lot of us say we are Buffettologists. We're students of Mr. Buffett. But Mr. Buffett, when he was asked, how come you're so successful? He said, to be successful over the long run doesn't require stratospheric IQ, unusual business insight, or any particular inside information. You don't need any of that. What's needed is a sound intellectual framework. A sound intellectual framework for making decisions. And secondly, the ability to prevent one's the ability to prevent one's emotions from corroding that framework. So two things we need, only two things. Having a framework that we make decisions based on, and make sure that we apply decision making against the background of that framework. And hence that's where we minimize the emotional factor. Okay? So that was my big lesson, life's lesson, I garnered in 1979 from that little book. It cost me probably $10, but it has been indelible. It made an indelible imprint on my career, on how I advise clients, the principles that I have as a business person, the principles that I have as an investor. Now, my second pivotal moment came throughout the crisis, which is another moment. It's a learning experience that I've had because of the crisis. And in 2007, here's my experience. I sold a business, Berkshire. Sold a business, I got cash, some cash, and I got shares. The shares I got were trading at $39.15. The cash I got was cash. So my expectation at the time was 5 years later, those shares would be trading at 15% rate of return. 5 years later, they would have doubled to $80. That was my expectation. And the dividend would have been twice as much. Those were my expectations 5 years later. Today, in looking back, the scenario is not that. The scenario is the shares went from 39 to 9. Today they're 12. And the dividends are cut in half. So I thought, oh my gosh. What? Then, that's scenario number one, retrospectively. Scenario number two, I took the cash and co-founded a business with another Canadian entrepreneur. His name is John Risley from from Clearwater Seafoods out of Halifax. Anybody have heard of John, Mr. Risley? Anybody? Well, John is my partner. We started this business called Columbus Communication. That business we started and the first big acquisition we made was an undersea fiber optic network that was laid by Motorola and a consortium led by Motorola in the late 1990s. Motorola spent $450 million laying that cable. It was in the era of global crossing. And the cable, undersea fiber optic cable starts from Boca Raton, Florida, and it hops to every single Central American, South American, Caribbean country, up the Eastern Caribbean, passes Dominican Republic, Cuba, US Virgin Islands, British Virgin Islands, back to Miami. Complete ring. 20,000 kilometers of undersea fiber optic cable. So Motorola and the consortium, and it hops to 22 countries. Motorola and its consortium paid $450 million laying this undersea fiber optic cable in the late 1990s. We bought it out of bankruptcy in 2006 for $80 million. So we took the cash, I took the cash, and we all got shares at $1 per share. It's a private company. Other shareholders would include, we manage a private equity fund also, or private equity fund invested in it. Other shareholders would include Goldman Sachs and the Michael Dell family office. So those are our partners. And within our private equity fund, our limited partners or clients are Canada Export Development Corporation, the United States Treasury. Those are our clients. European Investment Bank, Verizon Pension Fund, and a fund of funds representing the state of New York, city of New York, Duke University, and northern state of North Carolina. Those are our clients. So we all invested in this Columbus business. We got the shares then was $1 per share. 2 years later, in 2007, we got a dividend, 50 cents. $1, we got dividend 2 years later, 50 cents. Today, those shares are worth between $3 and $6 per share. So when I look back, just by virtue of my own experience, I think, oh my gosh, what if I didn't have a balanced portfolio comprised of public and private? Going through the crisis would have been a lot more difficult, more so than it has been. It would have been a lot more harsh, and if it was because of my privately owned businesses that made going through the crisis a little less harsh. Then I thought, oh my gosh, what did I do to my clients? Because as an advisor, all my clients, every aspect of what I've done for them, their entire portfolio is in 100% publicly traded securities. Am I right? Isn't that what we do? 100%. I felt awful because they depend on me. So I thought, there is a dysfunctionality in our system, another dysfunctionality in our system. Because once you've had an experience, you start to think about it more real. So I thought, Warren Buffett, Berkshire Hathaway. Let's go back to Warren Buffett, our role model. Berkshire Hathaway, if you look at Berkshire Hathaway's portfolio, what will you see? Would you see some public businesses and private businesses? Would you? Pardon me? Who has ever looked? In fact, the bulk of his businesses are private. 80% of his portfolio would mean private businesses. Only less than 20% in public. Coke, Gillette, Procter & Gamble, etc., etc. 80%. So when we say we are Buffettologists, when we are practicing Mr. Buffett's principles, are we really? If he has only 20% of his assets in public and 80% in private, are we really? Or are we just saying that for 20% of his portfolio? Fine. So I know, continued my thought process. I thought, you know, Ontario teachers, I don't know the experience. I went to India on a portfolio management visit. And when we landed in Turkey to refuel the plane, I couldn't believe what I saw in terms of the airport in Turkey. And what did I see? I saw an airport that was huge, modern, etc., which was the total antithesis of what I had expected. Turkey, bazaar, this place is filled with bazaar. Those were my perceptions, right? So I said to the aircraft handler, tell me about this airport. He said, well, this airport, I said, who owns it, by the way? He said, this airport is owned 50% by an Indian company, 50% by Ontario teachers. I thought, what? Ontario teachers? Is it public or private? No, private. Ontario teachers? Then I thought to myself, wow, suppose I was a teacher in Ontario. And I asked this handler, and by the way, he also said, this is the 4th busiest airport in Europe. Turkey's a hub. That's the reason why. I said to myself, suppose I was a teacher from Ontario. And I heard what the handler just told me, that this is owned 50% by Ontario teacher, and I came back to Canada and said to my advisor, I would like to invest. I got an opportunity while I stopped in Turkey to invest in a piece of an airport, the the main airport in Istanbul. And I'd like to invest in that. What do you think my advisor would have said to me? Are you mad? Invest in what? Then I would say to my advisor, but I'm confused. Because on one hand, you're asking me if I'm mad. Yes, see, my pension fund is investing in this. So who is right and who is wrong? So these are experiences that I've had that really connected with me. Then I went to Colombia. We're investing heavily in Colombia. Colombia, perception. What's the perception? When I say Colombia, what do you think of? What do you think of? Not an investment haven, right? So we are investing heavily in Colombia. So now I thought to myself, suppose I came back here as an investor and said to my advisor, look, I'm invested in Colombia. What do you think my advisor, I want to invest in Colombia. What do you think my advisor would say to me? Am I mad? But then I would say, but Scotiabank just paid $1 billion for 50% of Colfondos. Is Rick War mad? Or are you ignorant? Which? Tell me. There's something that is not right here. So ladies and gentlemen, the point is, we have to be careful that we are not just following along like lemmings, because I was a lemming. Right? We have to be careful that we are not just following along like lemmings. And it's easy. We have to be careful that we don't forget that if we want to build the most successful career and feel most fulfilled, we have to do 3 things. Number 1, we have to make sure we build the best reputation, make sure we differentiate ourselves, and make sure we really address our clients' needs. But that's difficult in our present environment, in our present structure, because the securities industry is, we as advisors are a subset of the securities industry. Advisors are a subset of the securities industry. Am I right? So and the securities industry makes its money by taking businesses from private to public and building an ecosystem around that, which is options, warrants, rights, derivatives, etc., and trade them. That's how the securities industry, mutual funds, seg funds, etc., etc. And we are the pawns to the securities industry. That's my conclusion. So I thought to myself, I am not going to be a part of something that I don't believe in. Because why should, if my clients' needs are, number 1, protect their capital, 2, get growth, number 3, invest to get income, and number 4, invest to minimize taxes. If those are my clients' needs, and I look around and I ask myself the question, who in the world are best fulfilling those needs? My conclusion is, number 1, the wealthy business people, number 2, the wealthy pension funds. Ontario teachers, CPP, OMERS, Harvard Endowment Trust, Yale Endowment Trust, those are the ones who are really doing the best job. And by the way, they have the same needs as my clients. So let us take a look. And all you have to do tonight is go and look at Ontario Teachers' website or CPP's website and ask the question, what percentage of their portfolio is in public versus private? What do you think you'll see, Ontario Teachers? What do you think you'll see? 50% public, 50% private. And then ask yourself the question, clients of advisors, what percentage of their portfolios that us as advisors put the clients into are in private versus public? What percentage? Pardon me? I didn't hear. What's your name, sir? 100%. Does that pique your interest as to why? So I keep asking the question, and I'll ask it here again today. Give me one reason, just one, why any client should have 100% of their portfolio in public securities. Just one reason, please. But that's what we do. So I thought, I am not going to be a part of a system that I don't believe in. So we're going to start a business that will start it from scratch, because we have the experience at investing in directly in private businesses. We have the experience at managing private equity funds, as I've mentioned to you. So why don't we create a business, which we're doing, which we have done, that will give our clients the ability to have a portfolio constructed, which is a mixture of private and public, highest quality privates, not just a participation in a restaurant down the street, right? The highest quality private that any institution would love to get into, like Columbus, like a power plant, right, etc., etc., and the highest quality private equity funds. And so that clients can now build a portfolio that is no different in profile from that of Ontario teachers. Give them access. Right now, they don't have access. So that's what we're doing. And if you think about it, I'll spend 5 more minutes. If you think about it, again, we come back to how is wealth created. You walk down the street, you see lots of different industries, lots of different entrepreneurs going to work every day. So let us follow the life of your typical business person. Your typical entrepreneur owns a business, a private business, and your typical entrepreneur goes into work every day for 30 years and work this private business, whether it's a coffee shop or a practice like yours, right? Or a garage or a restaurant or a machine shop, doesn't matter. So at the end of 30 years, your typical entrepreneur will get tired. Then the securities industry will say, look, we have a solution for you. You can sell your business, we'll sell it for you. You can get cash, and we'll put together a nice portfolio for you that will do the following 4 things for you. It will protect your capital, it will give you income, give you growth, and minimize your taxes. So the tired, fatigued business person says, sounds great. So on Friday, he or she sells his business after 30 years. Saturday, an advisor comes, sits with the businessman, former businessman, and says, look, let's put together a portfolio for you. Invariably, the portfolio consists of bonds, publicly traded bonds, pools of publicly traded bonds, stocks, publicly traded stocks, pools of publicly traded stocks, mixed and matched to help achieve the client's needs, those 4 needs, right? Invariably. So, Sunday, nothing happens. Sabbath day. Monday morning, first thing, what does the client do? Turns the TV on to CNBC. Turns the computer on to Bloomberg. Right? And asks the question, is it a red day or a green day? Am I off base here? Red day or green day? If it's a red day, how does the client feel? Terrible. If it's a green day, how does the client feel? Good. So the client's days are now determined by red or green. So in November of last year and April of last year, the client turns the TV on, turns this Bloomberg screen on, and it was brilliantly red. So the client now calls his or her advisor and says, why is the screen so red? The advisor says to the client, haven't you heard? Heard what? About the pigs? Who are the pigs? Portugal, Italy, Ireland, Greece, and Spain. So what does that mean to my portfolio? Oh, your portfolio is down 15% today. But my gosh, I live in Dundas, Ontario. What do I have to do with the profligacy of the Greeks? Why should I suffer? Oh, you're now in an interconnected world. I didn't bargain for this. And by the way, over the last 30 years, while this person was creating his or her wealth, did he care whether it was red or green? Did he care 1 minute for 1 minute of the day? No. So now let's go through the characteristics of the businesses, of his or her business while it was private, and then contrast that to the characteristics of his or her new world. Firstly, the business that he owned or she owned was never one day run by committees. He or she was a chairman, chairperson, CEO, floor worker. Am I right? Okay. Never one day. And because it wasn't run by a committee, the business was entrepreneurial and nimble. That's how it created wealth. Secondly, periodically, or this entrepreneur, business person, never one day received liquidity by taking 10,000 shares from of the company, selling it off to get 100,000 to buy a car. Never one day did that. Nor could this business person hypothecate those shares to the bank and borrow 100,000 to send his or her children to Harvard. Couldn't. Liquidity only came from profits. No profits, no liquidity. Secondly, this entrepreneur, this business person, periodically the business makes a profit. Then this person has to allocate that profit. If the allocation was a positive, buy a new plant, a new company, if it's a if it was a good investment, his or her net worth increased. If it's a bad investment, his or her net worth decreased. Risk-reward ratio perfectly symmetrical. Am I right? Okay, never one day was this entrepreneur, this business person, guided by quarterly analyst expectations. Never one day. What the hell is that? And lastly, this business was never, his or her business was never marked to market every day. And by the way, this person had absolute skin in the game. Skin in the game. So that's the world that this person grew up. Every entrepreneur, every business person, that's their world. That's how they created wealth. That's how wealth is created in every corner of the world. Then we now put this person into a portfolio. So let's look at the characteristics of these businesses that are the foundation of the portfolio. Every one of them are public. And under the auspices of good corporate governance, they all have to have a board of directors and management committee. Am I right? Under the auspices of good corporate governance. Under the auspices of the best corporate governance, the majority of the board of directors should be independent. Am I right? Should be independent. But the hallmark of investing is understand what you own. How can people who are ex-lawyers, ex-politicians come in and run a business that my future is based on? That doesn't make any sense. And by the way, how about skin in the game? How much skin in the game do these people have? Huh? That's one of the auspices of the best corporate governance. But that's the system we work under. Then you have these different committees that are making decisions. So we have a nice democracy running here, whereby when the wealth was being created by that business owner, it was a brutal autocracy. Right? Decisions are made. You sit around the table in a committee, you can be assured it's not necessarily the best decision for the company that's going to be made, because the board members have to play nicey with each other. Right? They don't want to tick each other off, as this entrepreneur would. So, because these businesses are now run by committees, they're not nimble and entrepreneurial. Periodically, these businesses have to make capital allocation decisions. If it's a good decision to buy another company or to buy another plant, they get a bonus. Management gets a bonus. If it's a bad decision, they get half the bonus. If it's a really bad decision, they get a golden parachute. The risk-reward ratio, is that symmetrical or asymmetrical? Asymmetrical. And lastly, these businesses, every single one of them that our client's foundation is now built on, every single one of them are guided every quarter by analysts' quarterly expectations. Every single one of them. And because management doesn't want their stock to be punished, management now starts to listen to the analysts. But the question is, where do the analysts get the information from? From management. So the analysts get the information from management, put it on a spreadsheet, linearize it, and then say to management, look, your earnings this year has to be 10% greater than what it was last year. And if it's not, we're going to write a bad report and punish your stock. Management doesn't want their stock to be punished because their bonus is a function of it. What do they do? Start listening to the analysts. Please tell me, ladies and gentlemen, am I out from Mars? Is this what you see every day? Am I way off here? So it's like the tail wagging the dog, the head. And lastly, all of these businesses that our clients have, they're marked to market every second of the day. Noise. So they are unable to think long term. So we have a system here, I submit, ladies and gentlemen, that needs to be overhauled. We have a regulatory environment that is regulating something that is dysfunctional. So we have to really ask ourselves the question, what am I really doing as an advisor? Am I doing the best job for my client, or am I just a pawn? So ladies and gentlemen, I came here this morning with the intent of just giving you my perspective based on my experience and my history. And I would suggest to you that Mr. Buffett, if we are going to claim that we are we have a role model in the likes of Untitled Teachers, the most successful investors, if we're going to claim that Mr. Buffett really is the world champion, heavyweight champion in terms of investing, make sure our behavior is no different from his. Our behavior is no different from that of Untitled Teachers. We give our clients the ability to build portfolios that are in no different a construct and profile than Mr. Buffett's portfolio, than Untitled Teachers' portfolio. Thank you very much.
Thank you, Michael. Thank you. We are going to break in just a moment. I would hope that Michael might be able to stay around for a few minutes to talk with individuals during the break. Michael, I want to thank you for sharing kind of your personal, professional journey as you've arrived at these thoughts in terms of investments moving forward. I myself have been very involved with the Ontario Teachers Pension Plan for many, many years, and so I know some of the stories that you speak of. Everyone in this room, as I listened and watched, were certainly paying close attention, and yet in many ways you were kind of destroying the model upon which many of us live.
On which I live also.
and on which you live. So that's what this forum is about. This forum is meant to be an opportunity to exchange ideas, to critique ideas, and to learn from one another. So thank you very much, Michael, for that opportunity. Thank you.